Listen up. What I'm about to drop on you isn't some conspiracy theory cooked up in someone's basement. This isn't clickbait. This is documented policy that went live on January 15th, 2026, and it fundamentally rewrites the rules of how your money works in the banking system. The Federal Reserve just pulled off one of the most significant regulatory shifts in modern banking history, and the silence around it is absolutely deafening. Here's the bombshell. The reserve ratio for commercial banks holding over $50 billion in assets has been slashed from 10% down to 3%. Let that sink in for a second. For every $100 you deposit into your bank account, they're now only required to keep $3 sitting in actual reserves. The other 90 cents, it's gone, loaned out, invested in securities, pledged as collateral for derivative positions, spinning through the financial machinery like chips on a roulette table. Your cash isn't sitting safely in some vault. It's being weaponized, leveraged, multiplied across the system, and the safety buffer that once protected you from bank runs and systemic collapse just got gutted by 70%. This isn't a market crash. This isn't panic-induced rumor-mongering from financial Twitter doomers. This is official Federal Reserve policy, implemented quietly, deliberately, and with surgical precision. And what it signals is way more disturbing than any interest rate announcement you'll hear parroted by mainstream financial media. The Federal Reserve is pre-positioning the banking system for a liquidity crisis. They're allowing banks to operate on razor-thin capital cushions because they know those institutions are going to need every available dollar of lending capacity in the coming months. And when central banks loosen reserve requirements during what's supposed to be an economic expansion, it's not because everything's fine. It's because they're bracing for impact. Over the next few thousand words, I'm going to dismantle this policy change piece by piece. I'll show you exactly what reserve requirements are, why this change is exponentially more dangerous than any headline you've scrolled past this year, and most critically, what this means for your deposits, your portfolio, and the systemic risk quietly inflating beneath the surface of financial markets. I'm going to walk you through the historical precedents, the mechanical breakdown of how this creates instability, and the three asymmetric positions you need to understand right now if you want to protect yourself from what's coming. This isn't fear-mongering. This is about understanding the rules while they're being rewritten in real time right under your nose. So kill the distractions, lock in, let's break this down. Before we dive into the current situation, you got to understand the foundational architecture of modern finance, fractional reserve banking. If you don't grasp this concept, you can't possibly understand the magnitude of risk you're accepting by keeping significant wealth inside the traditional banking system. Fractional reserve banking means banks don't hold all your deposits in cash. They hold a fraction, a small slice, and loan out the rest. When confidence is high and defaults are low, this system hums along beautifully, generating profits and fueling economic growth. But when depositors lose confidence and try to withdraw their money all at once, the system implodes catastrophically. Why? Because the cash simply doesn't exist. The reserve requirement is the regulatory guardrail designed to prevent this nightmare scenario. It's the mandated percentage of deposits that a bank's got to hold in liquid reserves, either physical cash in the vault or deposits at the Federal Reserve itself. For decades, that requirement sat at 10% for large banks. It wasn't foolproof, but it created a baseline liquidity buffer capable of absorbing moderate stress. On January 15th, that baseline got lowered to 3%. Let me paint this in concrete terms. If you deposit $100,000 into a checking account at a major commercial bank, that institution is now only required to keep $3,000 available. The other $97,000 gets immediately deployed into the lending market, securities purchases, repo agreements, the vast complex web of financial instruments designed to generate profit for the bank. And here's the kicker. That $97,000 you think is yours, it's now someone else's mortgage, someone else's corporate bond, someone else's car loan. Through the magic of the money multiplier effect, it's been relent multiple times over, cascading through the system like a chain reaction. If you and every other depositor at that bank decided to withdraw your money on the same day, the bank would have $3,000 for every $100,000 in claims. That's a 97% shortfall. There's no mechanism to cover that gap except emergency borrowing from the Federal Reserve. This isn't a flaw, this is the design, and the Federal Reserve just made it 70% more fragile. Context is everything, and the timing of this policy change is a flashing red siren. The United States is drowning in over $36 trillion in federal debt. Corporate debt has exploded past $13 trillion. Household debt is closing in on $18 trillion. We're sitting on top of the largest debt mountain in human history, both in nominal terms and as a percentage of GDP. And that debt? It got accumulated during a decade of near zero interest rates when borrowing was essentially free. But those days are over. The Federal Reserve raised rates aggressively in 2022 and 2023 to combat inflation, and even though they've paused or cut modestly since, the damage is done. The cost of servicing all that debt has exploded. Corporations that borrowed at 2% are now refinancing at 6% or 7%. Governments that issued bonds at rock-bottom yields are watching interest payments devour larger chunks of tax revenue. Consumers with variable-rate loans are seeing monthly payments double or triple. This creates a vicious deflationary feedback loop. Higher debt service costs mean less money for consumption and investment. Less consumption means weaker economic growth. Weaker growth means lower tax revenues and higher default rates. Higher defaults mean banks take losses on loan portfolios. When banks start losing money, they pull back on lending, which accelerates the deflationary spiral. The Federal Reserve knows this. They also know the traditional playbook, cutting interest rates to stimulate borrowing, is politically and economically constrained. Inflation's still above target, and cutting rates risks reigniting inflationary pressures. So instead of lowering rates, they're doing something more subtle and infinitely more dangerous. They're lowering reserve requirements to free up bank capital for lending without having to cut rates. This is financial engineering at its most cynical, and it's a signal that the Fed's more terrified of a credit crunch than they are of inflation. In March 2020, at the onset of the pandemic, the Federal Reserve made an emergency decision to reduce reserve requirements to 0%. Zero. Banks were allowed to lend out 100% of deposits with no reserve buffer whatsoever. The justification? The economy was in free fall, and credit needed to flow freely to prevent total collapse. That emergency measure was supposed to be temporary, but it stayed in place for over 2 years. It wasn't until late 2023 that the Fed began reintroducing reserve requirements, initially at 5%, then adjusted to 10% in mid-2024 as part of what they called a normalization process. But now, just 18 months after reinstating a 10% requirement, they've slashed it back down to 3%. That's not normalization. That's desperation dressed up in regulatory language. And if you look at what else has been happening in the banking sector during this same period, the picture becomes crystal clear. In March 2023, Silicon Valley Bank collapsed in the second largest bank failure in U.S. history. It got followed within weeks by Signature Bank and First Republic. The proximate cause? A classic asset-liability mismatch. These banks had gorged themselves on long-duration treasury bonds and mortgage-backed securities during the zero-rate era. When rates spiked, the market value of those bonds cratered. The banks became technically insolvent on a mark-to-market basis, even though their depositors had no idea. When word leaked out, depositors ran. The banks collapsed. The Federal Reserve and FDIC intervened with emergency backstop facilities, guaranteeing deposits above the $250,000 insurance limit and providing liquidity to other regional banks to prevent contagion. The intervention worked in the short term. The panic subsided, but it didn't solve the underlying problem. Regional banks across the country are still sitting on massive unrealized losses in their securities portfolios. According to FDIC data, U.S. banks were holding approximately $650 billion in unrealized losses on securities as of Q3 2025. That's $650 billion of your deposits backing assets worth significantly less than their book value. And now, the Fed's just told these same banks they can operate with even less liquidity cushion. When a bank holds only 3% reserves, it means 97% of deposits are tied up in illiquid or semi-liquid assets, loans, bonds, derivatives, securities. If a shock hits the system, whether it's a wave of corporate defaults, a commercial real estate collapse, or a geopolitical crisis that spooks markets, those assets can lose value rapidly. But the deposits? Your deposits remain as liabilities on the bank's balance sheet at full face value. This creates an instant solvency problem. The bank owes you $100, but the assets backing that liability are now worth $80, $60, or even less. If you try to withdraw your money, the bank's got to sell assets at a loss to raise cash, which makes the solvency problem worse. And if other depositors see the bank selling assets at a loss, they panic and try to withdraw too, forcing more asset sales at even steeper losses. This is the classic bank run dynamic. It's exactly what happened in 2023. The only reason it didn't cascade into a full systemic meltdown is because the government stepped in with unlimited guarantees. But here's the question you need to ask. Can they do that again? The political environment has changed. There's way less appetite for bank bailouts than in 2008 or even 2020. Debt levels are higher, constraining fiscal flexibility. the public skeptical of interventions that benefit Wall Street at Main Street's expense. If another wave of bank failures hits, the tools to contain it are limited. And the reserve requirement reduction signals the Fed knows liquidity is going to be the choke point. This reserve requirement cut doesn't exist in isolation. It's part of a coordinated policy framework, all pointing in the same ominous direction. At the same time, reserve requirements are getting slashed. The Federal Reserve has extended the Bank Term Funding Program, BTFP, through June 2026. The BTFP got created as an emergency facility during the March 2023 banking crisis to provide liquidity to banks needing to borrow against securities portfolios without selling at a loss. It was supposed to be temporary. It's now been extended 3 times. That tells you banks are still under stress and still relying on Fed support to maintain liquidity. Meanwhile, commercial real estate delinquencies are accelerating. Office buildings, retail centers, even multifamily properties are seeing rising vacancy rates and falling valuations as work-from-home trends persist and consumer spending weakens. According to TREP data, the delinquency rate on commercial mortgage-backed securities hit 6.8% in December 2025, the highest level since 2014. And remember, regional banks hold approximately 70% of all commercial real estate loans in the United States. When those loans default, losses flow directly onto already strained bank balance sheets. Add to that the maturity wall. Over $1.5 trillion in commercial real estate debt is maturing in 2026 and 2027. The vast majority can't be refinanced at current interest rates without borrowers injecting massive amounts of new equity. Many borrowers don't have that equity, meaning they'll default. Banks are going to be forced to take ownership of properties worth way less than loan balances. This is a slow-motion train wreck. The reserve requirement cut is the Fed's way of giving banks breathing room to absorb losses without raising capital or curtailing lending. But it comes at the cost of systemic stability. This isn't the first time reserve requirements have been weaponized as a crisis management tool. In the lead-up to the Great Depression, reserve requirements were inconsistent and inadequate. Banks operated with thin capital buffers. When the stock market crashed in 1929 and the economy contracted, depositors lost confidence and rushed to withdraw funds. Between 1930 and 1933, over 9,000 banks failed, wiping out the savings of millions. The Federal Reserve, created in 1913 partly to prevent exactly this cascade, failed to act as lender of last resort. The banking system collapsed. The lesson? Reserve requirements matter. They're a critical buffer preventing isolated shocks from becoming systemic crises. In response, the Banking Act of 1933 created the FDIC and established standardized reserve requirements. For decades, those requirements provided stability. But over time, as financial markets evolved and banks became more sophisticated, requirements were viewed as archaic constraints on profitability. The deregulation wave of the 1980s and 90s chipped away at standards, and by the 2000s, banks operated with increasingly complex balance sheets and thinner capital cushions. The 2008 financial crisis was the inevitable result. Banks leveraged themselves to absurd levels. When housing collapsed, the entire system nearly went down. The response was supposed to be a return to prudence. Dodd-Frank and Basel III regulations increased capital requirements and reduced leverage. But here we are in 2026, and the Fed's moving in the opposite direction, cutting reserve requirements when systemic risks arguably higher than 2008. The second historical parallel is the savings and loan crisis of the 1980s and early 90s. S&Ls specialized in residential mortgage lending. During the 70s and early 80s, they got caught in a brutal interest rate squeeze. They'd issued long-term fixed-rate mortgages at low rates. But when Paul Volcker raised rates aggressively to fight inflation, deposit costs skyrocketed while mortgage income remained fixed. This created massive losses. Over 1,000 S&Ls failed between 1986 and 1995. The total cost to taxpayers exceeded $130 billion, equivalent to over $300 billion today. The S&L crisis was a textbook case of what happens when financial institutions operate with inadequate capital buffers and take on duration risk they can't manage. The regulatory response was to tighten oversight and increase reserve requirements. But that lesson's been forgotten. We're now watching banks take on similar risks in commercial real estate and securities portfolios while being allowed to operate with even thinner reserves. Positioning's everything. Here are 3 asymmetric strategies. First, physical precious metals, not ETFs, not mining stocks. Physical gold and silver you control directly, held outside the banking system. When reserve requirements are this low and systemic risk this high, you can't afford to have all your wealth in bank deposits. Claims on an institution's solvency. Physical gold and silver have no counterparty risk. They can't be diluted by central bank printing. They can't be bailed in by a failing institution. They've functioned as money and stores of value for 5,000 years across every civilization and currency crisis. Right now, central banks globally are buying gold at record pace. In 2024, they purchased over 1,000 metric tons, the second highest annual total on record. China, Russia, India, Turkey, and Middle Eastern sovereign wealth funds are accumulating. They understand that in a world of fiat debasement and systemic banking fragility, gold's the ultimate reserve asset. If you don't have at least 10-20% of liquid net worth in physical precious metals stored securely outside the banking system, you're taking on uncompensated systemic risk. Second, high-quality distressed credit and deep value equities. When credit markets tighten and banks pull back on lending, quality businesses with strong cash flows and manageable debt get thrown out with the garbage. This creates opportunities to buy assets at significant discounts to intrinsic value. Focus on companies with fortress balance sheets, recession-resistant revenue streams, and management teams that understand capital allocation. Energy infrastructure, utilities, consumer staples, select healthcare, businesses that generate cash flow regardless of macro environment, trading at valuations already pricing in severe downturn. The asymmetry. If crisis materializes, you're buying at depression-era prices. If it doesn't, you still own quality assets at a discount. Third, short-duration inflation-protected instruments and hard assets. This includes Treasury inflation-protected securities, TIPS, at reasonable real yields, short-term corporate bonds from high-quality issuers, and real assets like productive farmland, energy royalties, water rights. Avoid long-duration exposure where you're locked into fixed nominal returns destroyed by inflation. Instead, you want assets that either adjust automatically for inflation or have pricing power in an inflationary environment. Hard assets, things you can touch that produce real economic value, are the ultimate hedge against both currency debasement and financial system instability. The reserve requirement cuts one data point, but not the only one. In the last 90 days, Federal Reserve extended the Bank Term Funding Program. Commercial real estate delinquencies rose, regional bank stocks underperformed the broader market. Credit spreads widened in high-yield debt markets. The Fed stopped publishing certain monetary aggregates in real time. Reducing transparency, Treasury Department issued higher proportion of short-term debt rather than long-term bonds. Policymaker rhetoric shifted from confident optimism to cautious acknowledgement of elevated risks. These aren't signals of a healthy, stable financial system. These are signals of central banks and governments managing a slow-motion crisis, hoping to avoid panic. First, assess your exposure to the banking system. If you've got deposits above the FDIC insurance limit of $250,000 in any single institution, understand you're an unsecured creditor. In a bank failure, you could lose access or have funds converted into equity under bail-in provisions, spread deposits across multiple institutions under the insurance limit, or move excess funds into physical assets outside the system. Second, build a position in physical precious metals if you haven't already. This isn't a trade, it's insurance against systemic breakdown and currency debasement. Work with reputable dealers, take delivery, or use fully allocated segregated storage. Avoid numismatic premiums or paper substitutes. Third, reduce exposure to long-duration financial assets, especially bonds and bond funds. In an environment where reserve requirements are falling, credit risks rising, and inflation remains a threat, locking in low fixed returns for 10 or 20 years is guaranteed wealth destruction. Move into shorter duration, higher quality, or inflation-linked alternatives. Fourth, if you've got significant wealth, think about diversification not just across asset classes, but across jurisdictions and structures. Offshore accounts where legally appropriate, foreign property holdings, legal structures like trust creating separation between you and assets, redundancy in banking and brokerage relationships. Eliminate single points of failure so if one institution or jurisdiction experiences crisis, your entire net worth isn't at risk. Knowing reserve requirements have been cut to 3%, do you feel confident keeping the majority of liquid wealth in bank deposits? Or does this change your risk assessment? If it changes your assessment, what specific actions are you planning to take this week? The rules have changed. The buffer has been removed. Your cash is now leverage on a bank's balance sheet, not a guaranteed claim. This isn't about fear. This is about understanding the system as it actually operates and positioning accordingly. The reserve requirement just changed. Your cash is leveraged. The only question is whether you're going to act while you still have optionality to move, or whether you're going to wait until the exits are crowded and liquidity's dried up. Stay sharp, stay informed, stay ahead of the curve.